Sure. Well, welcome everybody. Thank you for coming. Christine Bowden and myself are happy to be here. My name's Karen Curran. I'm a grad, actually. I had graduated from my MBA here back in the 1900s. You can believe that. And I teach now introductory accounting and finance classes.
I'm a double bison. I'm not gonna go back to when I graduated.
Probably not the 1900s.
It was 1995.
Oh, 1900s. I'm not alone.
It was a long time ago, and yay, this year I get to contribute up to 30,000 in my 401k because I hit the big 50, unfortunately.
There you go.
I mean, I guess it's a good thing, bad thing. I'm not quite sure on that one. And I teach finance, and I've been here since 2000, and you probably weren't even born. I'm guessing. Well, I mean, I know some of you were, but I'm saying the students here probably weren't even born when I started here. So I've seen all the changes, but yeah, I've basically been here since 1991. So I've seen buildings come and go and everything else. So it's been a journey,
Yeah.
and I've loved every minute of it.
So we planned a basic introductory, seminar, I guess. So what we're going to do is we're going to start with a Kahoot, because that always gets everybody in a happy mood. So we're going to start with a Kahoot. So you need either your computer or your phone, and we do have prizes. This is just a what do you know, what don't you know, kinds of gives us an idea of where to start.
Prices of candy, because Jean knows I'm big on giving out candy. Usually makes my students happy.
Yeah. Okay, so
And just, this whole thing, we really want to be laid back,
gotta go over there.
ask questions,
Or if there's
we'll
someone there, you
answer
can
to
just
the
share.
best of our ability. Remember, we're not financial advisors, so we're giving you basic information and so forth. But anything we say here is not advice for you to take professionally. So just like
This, we are not financial advisors.
Disclaimer.
disclaimer.
Right.
It is. All right, so let me start us off here. Hopefully we have some sound.
Gonna have the sound.
I know, it's not the same without the sound. Let's see. Hopefully people are coming. It is. There we go. You have it?
No.
Yeah, if you've never played, you're gonna go to www.kahoot.it. And when you get there, it's gonna ask you for the game pin. You're gonna type that in. And then you're just gonna type your first name or whatever you want to be known as through the competition. And I believe you get to change your little person. I think you
I'm a dragon with a pacifier.
It's very fitting.
Which one? The dragon or the
I'll leave it.
Well, Nora, I'll tell you, I got my daughter, we have a bearded dragon. I got her a t-shirt. You like dogs? How nice for you. I raised a baby dragon. There's things.
Okay.
Yeah, a little bit.
It's gonna be.
Oh, I like the penguin.
See? Oh my God. Okay. Oh, very nice. Elvis, very nice.
Elvis cat.
Elvis cat.
Where's Claire? Claire's a unicorn with a mustache.
Exactly. I don't see her. You in there? You are? DJ. There we go. The skeleton. All right. I
He
think
came to play.
yeah. Are we ready? You think? All right. Here we go. Remember, this is just for fun,
It's
right?
just beginner.
Beginner. Finance begins with F for a reason. Fun. Okay. All right. Do you want to get a chance to jump into the Kahoot here? Well, would you like to play?
Sure.
Sure. We'll give it a
I'm
minute.
sorry, it was just all over the place. I went to the well, then it was there.
That's okay.
Oh, no, you're good.
We've got a minute.
Did you play Kahoot before?
Yes. Okay, so you know the deal. Who would you give the prize for the best person? I'm gonna have to go with the Elvis Elvis cat.
I don't know, I really like the dinosaur pacifier.
Yeah, I kind of like them too. Where do they plug that? Sophia? All right, here we go. We only know who the first three will be. Don't worry about it. We won't know if you're last.
I'll know where I am.
All right. Who are the owners of a corporation? Who are the
Oh.
owners of a corporation?
Oh, I was thinking you say.
If you can't see, certainly move over. The stockholders, look at that. They don't need us.
No, they
They
don't.
need us. Very good.
How am I ninth? I got it right.
Claire, where's Claire? Very nice. All right, here we go. Which investment represents a loan to a corporation? A loan to a corporation.
Oh, it's not. Oh, wait.
Lily was your major. Communications.
Liberal. Oh.
A bond. So the word bond represents debt. So in this case, we have Sage. Where's Sage? Very nice.
Great place.
All right, third question. Which investment is considered riskier? Or riskiest, I guess.
Yeah.
Absolutely. The stock market, we'll be talking quite a bit about that. DJ goes to number one with the headphones on and all. All right. Why do corporations issue stock? Very good. So 11 people. So to incorporate your company, the reason you're doing that typically is because you need so much cash to get it started or to advance where you are that you couldn't possibly get a bank loan. So you've got to have more people as owners invest, give the money to the company, so then that company can use it to build and grow.
So
Yes,
basically, the company has access to the money from the stocks.
correct.
Oh.
The corporation, the US corporation, it's very odd because it's its own person. It's a separate entity from its owners. So the corporation, separate from the owners, can sue someone and can be sued, but you as an owner of the corporation, being a stockholder, aren't involved in that lawsuit.
And just to clarify too, they get money from the stock, but they get it one time at the IPO, initial public offering. It's not, when you see the market going up and down, the company isn't continuing getting money from that. That's money being exchanged between the market players, the brokers, the dealers, the individual investors. The company gets money one time at the initial public offering. So think of them as, it's a new car, never been owned before, the stock's going to the market, the money goes directly to the corporation. After that, the money is being exchanged hands between the various investors. Okay,
So you selling to someone else are exchanging money for a stock,
has no impact.
but the company itself doesn't receive money again.
That's why it's so cheap to start off, like usually.
Not really that it's so cheap to start off. What they do is they do road shows. Okay, they hire an investment banker, they go out to the community, they do road shows to see what kind of interest there is out there. Plus, investment bankers, they have big clients, then they go to their big clients. So even though you hear in initial public offering, first time being sold, everyone jumps on like, oh, you gotta know it's already, you're not the first to hold it, to buy it. They actually sell to their big clients first. And that's why a lot of times when it hits the market initial public offering, you'll see it go up and it goes down right away. Why? Because their big clients have already bought. They bought at another price prior because it could go up overnight. Before it even goes to initial public offering, the price they set, they already decide they're going to offer it higher. And so the people who bought, their big clients already got a good price. If it could be, because it could be lower than the initial public offering. So they're going in and they're taking their profits and they're selling, which is driving down the price. And that's why you have to be very careful when you buy an IPO, because generally it does a nosedive right afterwards because people are capturing their gains. And also besides initial public offering, there's seasoned offerings. So companies, they need capital later on, they can issue more stock, brand new stock, and get that equity, or get that money from them.
Good question. By the way, if you have questions, that's really what we wanted to make this more of a discussion. So this would be a great way to start that too. All right, so Sage goes up.
I still in the lead.
Yeah. Here we go. Why do people buy stock? Very good. So for the most part, right, we all know that if you own stock, the hope is that the value of what you own is going to go up over time based on supply and demand. And then you'll be able to, at your choice, if you want to sell it. The difference for what you bought it for and what you sell it for is called the capital gain. Also, some companies do share profits with the owners, and that's called the dividend. So if you receive, money from the company, it's sharing profits, trying to keep you happy. That's what the corporation is trying to do. You are part owner, and they are trying to keep you happy. Happy stockholders means, that you're going to stay as an owner, and other people will want to buy, which drives the price up. All right. And Heather, where's Heather? Is that very nice? Here we go. As you age, financial advisors will recommend you have more blank and less blank in your portfolio.
Yeah, she was too, like I'm a CJ major, so it's like.
More bonds and less stocks. So in general, stocks are considered riskier than bonds. And essentially, when you're younger, you have plenty of time to make up for losses along the way because, if you're saving for retirement or investing rather for retirement, you can make up those losses over time. But as you get closer and closer to retirement age or even older, you're not going to have as much time on the other end to make up for those losses.
And there's usually a general rule. Some people like the 110, something like the 100 rule. You take that minus your age, and that usually tells you the percentage of equity you should be in and the rest that should be in bonds.
So think about that,
Just as a
100,
general rule.
110.
It's either 110 or 100 minus your age. That's the portion that you should be in equity, and then the rest should be in bonds.
And equity
Just
stock.
as a general, some people use this just as a general tool, so that's why you should rebalance as you get older. So if you do the 100 when you're 50, you should kind of be 50-50. And then you start moving, you should then, start going more into so forth. So it's like, tells you how much should be in the equity, so much should be in the bonds. So as you're 60, well, you should have less in equity and more in bonds. So you start making that shift because you get close to retirement. If you have a downturn in the market, you don't have the time to ride up that wave any longer. So it's telling you the proportion of your equity in your bonds. So some people like the 100 rule. Others who want to be a little bit more riskier will use the 110 rule to determine what portion should be, their bonds in their equity.
So equity is ownership. Ownership is stocks. That's what we're referring to when we talk about equity. Bonds refer to debt. So if you were to buy a bond from McDonald's, you're lending money to McDonald's. You're a lender to McDonald's, and McDonald's eventually, hopefully, will pay you back the money that you lent them, and then along the way will give you interest for the loan that you've given them. But you, as a loaning money is very different than being a part owner of a company. So we'll talk about some of those differences today. DJ is now on fire. Look at this answer streak. Here we go. A savings instrument that offers higher interest rates but less liquidity is a.
I think that is really high.
Yeah.
Yeah.
So does anybody know what a certificate of deposit is, or a CD? Do you?
It's like you give money to like your bank,
Mhm.
like for like a year or longer, and like you can't touch it, and they loan it out to people, but you get like a lot of interest back on it.
Yeah, your interest rate's gonna be a little better because you're promising the bank you're not gonna access your money. So you could purchase a 3-month CD, a 6-month, a 1 year, a 5-year, but you want to be sure that you don't need that money in that time period, because if you do, you're gonna not only, you'll get penalties basically, and it wouldn't be worth putting the money in that situation anyway. But that's what we're talking about, liquidity. How easy can you get your cash back? So if you're promising that, the bank that you're going to leave the money for a year, then your cash isn't liquid anymore. It's not. Liquidity is how quickly you can get your cash in your hands. So you wouldn't be able to have cash. So you have to think about that, right? You want to have an emergency fund in case something happens. If your emergency fund is in a CD that's tied up for a year, then you don't have any cash to help yourself with that emergency.
And usually if you're using CDs as part of your investments, it's good. We call that rolling. Usually like to have a 3, a 6, a 1 year, and that way you just keep rolling it over that way because you get a higher rate, and that way you keep yourself liquid, and you free up money for 3 months. You don't need it. You can put it back in. Then you free up money 6 months. You can put it back. So you keep doing that process over and over, and that's a way to get higher rates, but also keep yourself liquid and to avoid those penalties.
And this is a bank you're talking about. So the risk is, we're not talking about putting your money into the stock market here. We're talking about a bank. So, think about if you were to get a chunk of money, does all of it need to sit in a savings account? Maybe, a portion of it should for your emergency savings. And then, as Christine said, it's great to think about even just a little bit % bigger, because over time, that's what it is. It's those little things. You might look at the CD rate and it doesn't sound so impressive, but if it's 1% more than sitting, in a regular savings account, 1% here, 1% there, over time it adds up.
And I think rates are actually pretty good, right?
They are. How would you apply for one?
You can do that right at your local bank. You can go to the teller and say, I'd like to take X dollars out of my account and purchase a CD.
Okay.
And I like to go to bankrate.com. It's a great website. Bankrate.com. You can search for you can search for banks in any state, actually. It doesn't have to be where you live.
Okay.
And you can find out what the going rates are for different time periods. Obviously, the longer you leave the money, say for a 5-year CD, you're going to get a better interest rate than just a 3-month CD, but it's always going to be better than just a regular savings account.
And you use the word apply. I just want to correct that. You're not applying like they can turn you down or whatnot. It's more of you fill paperwork like you were to open a savings account and so forth.
So it's a guaranteed basis.
Yeah, as long as you have the money, you have proper identification and so forth.
Are the interest rates for those pretty similar across, like if I was to look at a bank local in Dudley or a bank in Southbridge or whatever, are they pretty much the same or?
It depends. Sometimes they'll have, the local area might be, but you could also purchase one in another bank in another state. It doesn't have to be the local.
Sometimes credit unions
Are a
usually
little better.
pay better. So you tend to, when you want to go to a credit union, they tend to have better rates all around
Okay.
on, even when it comes to loans and things like that. So when you're looking around, I usually start at a credit union and see what they have.
So if we have time at the end, I know we're saving we're sharing and all this, but we can look at bankrate.com and you can find out what the latest mortgage rates are, the latest savings accounts, money market account. That's just a glorified savings account that has check writing access. But you get a little higher interest rate because you have to have a minimum balance. So if the minimum balance is $5,000 and you don't mind leaving $5,000 in a money market account to keep it there, then you'll make a little bit extra interest because of that, and you can write a few checks from it. So that's another, thing to do, but it's not going to be all that much more than, your savings.
And like going along the lines of interest and so forth. I know we're going to get off topic here, but while you were students and, come out of college, maybe start thinking about buying a new car. Biggest thing I can recommend for you is, like the type of car you want, establish a relationship with the dealership. Get a salesman that you establish a relationship with. And that way, if you do that, like that's what I have. Whenever they have 0% interest for like 1 week, he calls me on the phone, I get 0%. that's when I go. I haven't paid a cent in interest in about 12 years on cars. I bought about 5 cars and I don't pay anything in interest. You know, my kids have gotten cars, everything. I never pay interest because they called me and said, I mean, one time my kid didn't even have a license yet, but I got 0% interest. I bought the car and it sat in the garage for 2 months until she got her license because I wasn't paying interest. So establish those things because you don't want to, that's more money in your pocket that you can be investing.
Right.
Than putting it in someone else's pocket. So little tricks like that can help you, you know, save money and have more towards other things.
I'd say the same thing for a bank. Most of us just use the bank that our parents used. So look around at local
Shawmut's not
banks.
around anymore, so I can't.
Yeah. Shop around, find out, you know, what deals they may have, especially for students. I know they have special accounts for students. Do any of you have any of that? What bank, do you mind me asking? Citizens, do you know what the special?
It's, I want to be bad about it. It's like, you don't have to have a minimum account or balance, and like, you don't need to like have money go into like every week or bi-weekly or whatever.
Yeah,
You have to get like cash to start it off,
so they're trying to get you as a customer, right? Because if, once you have that relationship, like Christine said, you know, when you need a car loan, that's where you're gonna go most likely. And someday when you need a mortgage, you know, so they really want to have you as a customer. So it's something to think
DJ
about.
in the back has a question.
She's got-
One of the best things you can do is pay off your credit cards every month as well. The interest rate on a credit card, you know, it varies quite a bit, but let's say 12%. So it doesn't make a lot of sense to put your money in a savings account or a CD earning 1% or 2%. And then carry a balance on your credit card where you're paying 12% interest.
We
And
actually.
they are paying 12%, as we know, right? Students are paying close to 29%
Right, so
interest. So it,
The
if you
rule,
can't afford to pay it off, then don't use it.
yeah, the rule is if you can't pay it off every month, then do not spend it and pay with cash because cash is an emotional transaction. Credit is not. If you have cash in your pocket and you go to the mall, for some reason, we have a harder time of letting that cash leave our hand versus tap or swipe or whatnot. But if you cannot pay it off each month, do not charge it.
one of the things I tell my students, because of course, you know, someday if you do go for a mortgage and you never used credit, then you're not going to get a mortgage. So, you know, I've told students, if you have your credit card, just use it for gas. Yep. That's it. Pay it off at the end of the month. You don't pay any interest at all if you pay the full balance off. So gas isn't very exciting, right? So if you just use it for that, or maybe a $10 gym membership at Planet Fitness and you pay it off every month, you're still establishing credit, but you're not, you know, getting crazy with it.
And right now, I mean, if you don't, not sure what your credit is, if you're not, you know, you want to establish credit, what I do with my kids, I had them piggyback off mine. And what I did was on my account, I added them. So my credit score became their credit score. And so even though my daughter was 17 years old, she had a fantastic credit score. She could have got a mortgage, I guess, if she had the income, but I had them piggyback off of me. So they had established credit and they weren't starting from zero. So you can always try piggybacking off of your parents if your parents have good credit. And you can try doing that, and that helps build your score. So you're not starting from ground zero when you get out of college.
All right, let's see if DJ goes down. Nope. Maya, where's Maya? Very nice. You're right there, Maya. Come on down. We can do this. Which is a popular index of 30 companies that is used to measure the US stock.
I don't tell me now, because that's where I was.
I've been cheating over here.
Oh.
The Dow Jones Industrial Average, referred to as the Dow, right, is, think of it as a thermometer, taking the thermometer of the US stock market. And the funny thing is, it only represents 30 companies, whereas some of the other indexes, I think I put up there, the S&P 500 represents 500 companies. But the Dow is the oldest. It
Yeah,
represents, you know,
It's one of those
historic.
things that
the
if you're
historical.
watching the market, you know the market, you don't really care what the Dow is doing because it doesn't really measure anything. It's more the S&P, and the S&P, I think it's up to like 510 now, and that really represents our entire economy. So that's really the one you want to follow. The Dow 30 is outdated, but it's just part of tradition that if we ever stop reporting on it, people probably like have a heart attack, like where to go? Like, and think like, you know, I don't know, like the company's collapsed or
Right.
something. They think the sky was falling. So we just keep reporting it, but it really isn't indicative of much.
All right. Which of the following drive the price of a company's stock higher? Very good, absolutely, right? You're looking at supply and demand. The more people that want the stock, it's like anything. If you think about, you know, I don't know what the toy was when you guys were growing up.
Cabbage Patch Kids.
For me, it was Cabbage Patch Kids, right? And you know, that's definitely, oh, sorry, I guess we went on. If 40% of a company's assets are financed by debt, what percent are financed by equity? Should be if 40%.
Oh, really?
Yeah. So I don't know if you go back, how many of you took financial accounting? Okay, so financial accounting, we learn our basic accounting equation, right? Assets are equal to liabilities plus equity. So everything you own, assets, right? You either have borrowed to buy them, right? Or you've, you know, in a case of a corporation, the equity came in from selling stock originally, or the company's been profitable and has retained some of the profit to buy those assets. So that's it. It's debt or equity for that company. How are they going to finance those assets? They're going to either borrow, they're either going to have money from investors originally that invested, or they're going to be profitable selling their product, being able to pay expenses and have something left over and retain some of it. So that's why, you know, 60 would be the answer. All right. Just moves up, very nice. What right do common stockholders have? To vote. So as a common stockholder, and there's different kinds of stock, we usually just talk about stock. Common stock is the most common, I guess is why it's called that. But you do have the right to vote for who is going to be a member of the board of directors. And that's important, you know, for a lot of people who don't own a lot of stocks. They're not necessarily excited to vote for who the, you know, is going to be the next person on the board. But for people who own a lot of stocks, right, that vote can matter. And if the board of directors changes, then that can shift the entire company's managerial perspective. And, you know, at that point, if stockholders are unhappy and they want out from who is managing the company, then they're going to try to change the board of directors. So that usually happens in a stockholders meeting, an annual meeting that most people, you know, that don't buy many stocks would go to, but you could go to. All right. You move down, it's okay. We're almost done here. In bankruptcy, blank have priority over blank in claims on the company's assets. Who has priority if the company is going bankrupt?
Don't go bankrupt, I guess.
Okay, so because bondholders aren't owners, right? Owners take the risk, the full risk. The bondholders are the ones who lent money to the company, so they would have priority and get paid back if there was enough to pay them back what originally was lent to them. After that, if there's anything left over, then the stockholders, the owners would have rights to that.
And know too that common stockholders, they're like the bottom feeders, so to speak. You have your senior debt. If there's money left over, it will go to the bondholders. They're probably not going to get paid back. Then there's something called preferred stockholders. Then there's common stockholders. Usually they run out of money even when they get to the bondholders, that no one gets any money at that point in liquidation.
And that's the risk of buying a piece of stock, right? You can't lose more than you invest, right? That's good. You invest $100, you're not going to lose more than $100, but you know, you could lose the full $100. So, did you have a question? You good? All right. All right, just a few more and here we go. What do corporate bondholders earn? Interest. So again, does anyone in here have a US savings bond? Your
Yes.
Yes.
Maybe your grandparents or parents purchased one for you when you were born. Any students? Or maybe you don't know. I don't know.
Yeah.
Okay. So it's typical, anytime you hear the word bond, it's a loan. So essentially, when you were born, your parents or grandparents loaned the United States government money. And that money is going to be used by the government and over time, right, is going to earn interest as far as the debt that they're borrowing the government. So 30 years later, typically, you'll be able to cash that bond in and get the original amount that was lent, but interest on top of that. So that's how a bond works for a US savings bond. Now you can't sell those to each other. There's no bond market. It's just, that's it. But corporations also sell bonds. So you could loan money to a corporation and the hope is that eventually they will pay you back, provided they're not out of business. And then along the way, you would get interest.
Yeah, and usually US bonds, they pay semi-annually every 6 months, where other parts of the world, Europe, they only pay once a year annual. But the annual, we are semi-annual, and just automatically assume when you purchase a US corporate bond, you'll receive interest every 6 months. And you know, that is a taxable event, so.
All right, very nice. All right, which of the following is an example of diversification? Buying an index fund. So does anybody know what an index fund is?
Doesn't it mimic the S&P or whatever? So it's like stocks that are made up of.
Exactly,
yeah.
exactly. You can buy a mutual fund, which essentially is many investors putting money together to have I always think of it as a basket of investments. So you as a single purchaser would get a slice of the basket, piece of the basket. So in this case, the index fund would be 500 companies that make up the S&P. Their stock is in it. So that gives you diversification there. Diversification means you're not putting all your eggs literally in one basket, right? With the same company. If one company does well, you know, some others might not. Hopefully over time it balances out.
And know though that your return on the index fund is not going to be the exact as you hear the S&P has a certain, you know, say you hear the S&P has return of 12%. Know your index fund, you're not going to have 12% because the fund is required by law to keep a certain portion in cash because they have to be able to redeem on a daily basis. So that cash is not invested. And so because of that, the return is, it will, you know, be similar, but it's not going to be exact because of that.
Oh boy. One more to go. Here we go. Which kind of stocks tend to be more volatile and riskier investments? All right, so small caps. Actually, let's just see who actually came out here, and we'll discuss the question in a second. Maya, very nice. Third place.
Oh, no,
Very nice. Second place. I love it. DJ. Very nice. All right, come on up and claim your prize.
Oh, can I donate it?
Donate it, but you're welcome to, why don't you grab it and then you can.
Right.
donate it.
Okay, all right. It's on my own.
Go
get your prize.
Sorry, guys.
I need money for the.
Oh, actually, that's what it is. There we go.
What's the?
Thank you.
what's
Oh,
the riskiest?
Thank you.
Small. Gordon
Yeah,
said small.
So the last question was about market capitalization, and you may have heard, you ever hear big, large caps or mid, small caps? I don't know if you've heard about that distinction among stocks. But market capitalization has to do with how many shares exist in the hands of stockholders. That number is multiplied by the stock price. So if you think about it, the more stock that exists for a company out in the hands of stockholders times whatever the price is, that becomes the market capitalization. So if the answer is larger than 2 billion, is it 10 billion? Or
250 million to 2 billion is a small cap, 2 billion to 10 billion is a mid, greater than 10. is a
greater than
large.
10 is a large cap. So that just gives you an understanding of, market capitalization. So the companies typically that are the large caps have a little bit less risk than maybe a small cap would in general.
And so when you hear like a company lost 4% that day, they lose like 4%, like all of a sudden 4%, like they had cash and ooh, where'd it go? It just meant their market cap fell by 4% of the previous day's value. So,
Which could be based on just number of shares being,
yeah,
the price
right.
changing is changing all the time. And that's, obviously something that's going to affect the market cap. All right, so how do we start with, that was kind of a good understanding of where everybody is, I think. And we just wanted to start with the difference between saving and investing. What do you think the difference is between saving and investing? Or is there a difference? Saving and investing. What do you think?
Well, investing involves risk, right? And saving, I mean. Saving doesn't involve, it might involve a little bit of risk, but depending on how you choose to put your money, but like long-term investing. Involves risk, but it's definitely, I don't know.
Well, no, you risk, absolutely. You mentioned long-term, so there's a time frame component involved that, typically shorter term saving is what you're thinking of, whether saving to get married or saving for a new car, saving for something, typically in the next few years. Whereas most of the time investing is more towards, it doesn't have to be retirement, but when we start to talk about things like 401ks or whatever, that's for the long run. If you're starting work at 22, then you're starting to save for when you're 65. So that's definitely, investing.
Yeah, and as far as the difference, short terms usually considered about 3 years. Intermediate is up to about 7 years, and then long term is greater than that. And that really determines what you invest in and the amount of risk that you can assume based on the goal period that you have set.
So this is pretty much what we were saying, 0 to 5 years roughly. So think about, especially when you graduate, what savings goals would you have? Many of us have student loans, and, typically when I teach the personal finance class, I ask students to do, their personal financial goals within the next few years, and then, intermediate and long term. And if the focus is always getting those student loans paid off. So the part that you have to be careful of is if you put all your money towards your student loans, then you're not able to start possibly putting into a 401k. So you don't want to hurry up and get all those student loans done, get that done in 10 years and then worry about your 401k, because you're basically giving up free money that the company is offering you. If you take out a certain percent of your check and put it towards a retirement account, the company, if they're matching, is going to put that amount in as well. And if you say, no, I can't do it, I got to pay these student loans, which you do have to pay them, obviously, but sometimes you have to think about doing it at the same time as saving for an emergency fund, having all of those things there rather than focusing on just one thing and then I'll worry about the next.
When we talk about setting yourself for the future and going on student loans, one of the big things to keep in mind once you're, independent and you start doing your own tax returns, you're probably gonna get a refund at your age. A lot of people will make the mistake and say, oh, I'm gonna go on vacation, I so need it, I deserve it, or shopping. You gotta take that refund, fine, take a teeny bit of it, take the rest of it, put it right into pay off your student loan, get that principal paid off, you're gonna knock time, years off of what you owe. You're gonna owe less with interest, but be disciplined in your early years if you can, because it will pay off long-term.
You start putting that money into the 401k or the 403b or whatever your company has right away, you're never gonna notice that it's gone. So that first paycheck already, that 3%, that you're gonna put in of your pay isn't gonna show up. You'll never notice if you just don't touch it.
We have time at the end. I have a 401k calculator I use with my personal finance students. I just used it actually about an hour ago, and they're blown away. It can be the smallest amount, but when you're starting at 22, think of the time that money has to grow, right? 40 years. If you wait 10 years, then you've missed out on those early 10 years where that was the money that was going to compound the most over the period of time. So it makes a huge difference. And, maybe we can look at one of those
I always tell
calculators.
students.
Go ahead. DJ.
Just wanted to offer a suggestion. One of the things you can do especially when you're young, when you set up a checking account, set up a savings account. And then when you get paid, put part of your paycheck into the savings account. And then once you accumulate some money, then open up an investment account and put the savings over into that, and then continue with the amount, putting money into your savings as well. But that way you're diverting money that you're not spending. If it's there, you tend to, especially when you're young, you tend to spend it. But if you force yourself to save, it accumulates over time a lot, just like.
And this can be done automatically. You can
Yeah.
have it set up through payroll. You don't even have to see the money going into your savings. I mean, you'll see it accumulate, but you don't have to do it yourself. And then whatever is left over for take home, you just live off that.
A big thing too, is I tell people, is treat yourself as expense, just like your rent, your electricity bill, your heating bill, your car payment. Make yourself an expense and have a certain amount of your paycheck go towards you, which is savings.
Yeah, it's called PYF, pay yourself first. So instead of waiting at the end of the budget, there's nothing left for me, you put it in there as a line item and you make it happen first. And then at the end of the month, my husband and I sometimes, just to be stubborn, will be like, well, we're not gonna go to the grocery store. Let's open up the pantry. We can figure something out tonight. Cause my kids will be like, oh, can't we just get pizza or whatever? I'm like, you know what? We're not doing that yet today. We're gonna look at the pantry and figure out something. And you make it work, because had we done it the other way, right? We would have ordered that, and then there would have been nothing at the end of the month to put towards what we were trying to
And
put
one of the
towards.
things I've always done, even since I was in college, way back in the day, is I always had a savings account that was separate from everything else. Because if you make it so it's not connected to your debit card or your online banking, again, that emotional connection. Some of us can't be bothered going to the bank to take out the money, so you make it harder to access it.
Yeah.
So I call it islands. I always tell my students, create islands. Create an island that has your deductible in it for your card in case you get an accident, so you can fix it. Create an island that's your emergency savings.
You can have
No,
multiple
create-
bank accounts. You don't have to just have one savings.
I have like
account and multiple.
10 bank accounts at my bank,
Mhm.
because some of them have special purposes and they're islands for certain days, certain things. And they're not connected. Only a certain account is connected to the ATM, and that's the only one that I hit. Everything else is separate. So I have to physically go into the bank, and I don't physically go into the bank and attack those. So
Mhm.
it's like little habits like that can get to where you can accumulate your wealth from. And it does accumulate. So
So here's exactly what you were talking about, risk. And, there is uncertainty. Obviously, we don't know exactly what's going to happen when you're putting money into the stocks. But we do have, I'll come back to this in a second. I just wanted to show you, this is the history of the S&P 500. So that's the index I was talking about, representing 500 US companies. And from 1926, and this doesn't even go up to today. Yes, there are highs and lows along the way, and that would be a really bad time to start retiring.
great
But-
time to buy.
Right, great time to buy. However, over time, right, and that's what you have over time, right? You have a long 40-year line that you don't have to worry right yet about what year am I pulling this out for retirement? So
And
that's,
because of the upswings, you can't, if you don't have the tolerance to just let it ride, then you shouldn't be in the market. If you're one of those, you gotta look at every day, be like, oh my God, I'm down 500 and you're pulling your hair out, you should not be in the market. You gotta ride it out. This is a saying, the best investor is a dead investor because they forgot the money was there. And all of a sudden they have this huge amount, 40 years later.
I think that's been.
Yeah, but no one has touched it because if you try and time it, you end up, you wait, before you realize it's even going up, you already missed a jump. And so you gotta ride it out. You gotta know it's gonna go through ups and downs, but it's gonna come back up. That's just the nature of it. And that this example just proves that. So you gotta make sure that it's gonna go up, it's gonna go down, but that's the whole point of reassessing as you get older. You have to change your portfolio mix. Because as you get closer to retirement, you don't have time to wait this out.
Don't put it all in the stable fund at 20.
right, exactly, because you can afford the risk, right? That's the point. But back to, let's go back here. We talked about the difference between saving and investing and the opportunity of safety versus risk. Some of the options, cash, obviously having something liquid in case there's an emergency. But there are other things. I mentioned money market accounts. You could go into your bank and take your money or put additional money into, instead of a regular savings account or a regular checking account, a money market account, which is a glorified savings account. You get a little bit better interest rate. You can still write a few checks, but you do have to keep a minimum balance. So you would want to find out what that minimum balance is, but that's another option instead of just a regular savings account. And then there are other things called treasuries. Treasuries are, again, loans to the government. There's different periods of time that the government would borrow that money. A T-bill, it's called a treasury bill, is a short-term loan to the US government. So these are loans that are, pretty safe. It's the United States government. So you're not going to make a huge interest off it, but it's going to be a little better than a regular savings account. The other side, investing, we're going to talk today, which we haven't talked today, about stocks, bonds, mutual funds. We mentioned index funds and property, of course, real estate would be an option.
And also going on that money market, there's also something not to confuse with money market funds. There's mutual funds that are money market funds. It's $1 a share. It's always $1, and you tend to earn a better rate there. So that's a level of safety and liquidity too that you can use within your 401k or 403b or whatnot.
The money market account is just a bank account at your bank. The money market fund, that's where it gets confusing, is an actual mutual fund, a basket of safer type investments that you could have a slice of. All right, so we looked at this. So this is the long haul. And then we have a little excerpt here of, in between that long haul of 40 years, Christine and myself don't have 40 years for our investments. So we're going to have to monitor, what we think is going to be going on when it comes closer to retirement, because, the goal is that this is when we want to start pulling our money and using it, not necessarily over here. So. All right. So just different levels of risk. Again, you'll see the highest with the 4 that are here, the small caps. So this is, again, the market capitalization we talked about, number of shares that are out there in the hands of stockholders times the stock price. You're going to have a higher level of risk, but yet the return, the potential is more. That's the risk versus reward relationship, but everyone's different. Also, I think if we have time, we're going to should we hand that out now? Let them look at it, or do you want to wait?
Well, are we getting close to that?
It could be.
I think it's not too true.
So basically what I was saying is everyone has a different risk tolerance. So what a financial advisor would do would sit with you and ask different questions about how risky you're willing to be. And then whatever you explain to them, they will make recommendations for you as far as what to invest in. And there's different tools. We have one that we're going to use with you just to ask you some questions to see what you might answer and then come up with some recommendations based on the analysis. Okay. All right, so this really just goes through the difference between if you were to take $1,000 and put it in a savings account versus,
Stays pretty flat.
yeah, versus actually investing it in an index fund. So whether it's a fund that matches the S&P 500, or there's other funds as well along the way, Russell 2000, Russell 5000, et cetera. And you can see the difference, right? Over time, stays pretty flat, the same at the beginning, but as the years go on, this isn't going anywhere. But the investment in this example ended up being about 20,000 versus 2,000, and this was an 8% average return. The historical return since the beginning of the stock market, 10%
Yeah,
average.
and you also have to take in consideration too, 8% return, generally inflation between 2 and 3%. So you gotta take that into consideration. So your real return really isn't 8%. Here, you're probably down under below the line here, you're probably negative because of inflation. And so you gotta be careful there. You always want to make sure you're earning more, or keeping, even in retirement, you want to make sure you're keeping pace with inflation, so you're not losing that purchasing power. Otherwise, you're having negative compounding there, so.
Any questions? So we're doing here so far? Keep going. This is one of my
Oh, that's
favorite
your
slides. I tell my students to print this and hang it on their refrigerator and look at it every single day. It is the story of two people, and it's actually unrealistic. And you'll see when we look at this. We have Saver A, who at the age of 18, like most people, puts nothing into an investment. Does nothing. Finally, at the age of 26, decides to put $1,800 a year into a I think that it's a 12%, which is high. We can actually, it doesn't matter necessarily what the percent is. The end result is going to be the same as far as who has more money. But this person does this for 40 years. So you can't even see some of the years. It starts skipping 30 to 35. So $1,800 every year for 40 years. They contribute themselves $72,000 to this investment that's earning 12%. So at the end, by the age 65, they're at $1.7 million, which sounds great, right? That's what most people do, although most people aren't starting even at 26. A lot of times they're waiting to start a little bit later, so they're not even going to end up with that kind of a large balance. But this opportunity here, it blows me away every time. It's just for an example. If this person had put 1,800 in at 18 and stopped at 25 and never put anything in until they were 65, which no one's going to do that, right? But just an example. They only would have contributed $14,400 to this investment. And after the age of 26, they couldn't contribute to it. But whatever the basket of investments is that they've been invested in, over time, right, is going to hopefully have more value. So at the end of, the period of time, they're at $2.2 million, only having invested $14,400. So it doesn't matter if it's 12% or 8% or 5%. The answer is Saver B will always have more money. And, if you're already 21, then yes, we've missed out. But the point is start early, because look at this person just started early and then never continued to invest and ended up having more money. So it really shows you the importance of early investing. So that's major. Can you tell I get excited every
You're
time?
talking about tax deferred account, you're talking about IRA or, okay.
So
So
tax deferred, so something like money going into a 401k every paycheck is money that you didn't pay taxes on. So what's happening is, over time, you're gonna, hopefully that money's gonna accumulate over time. And then when it is time to retire, you will have to pay taxes on it when you withdraw. So that's why it's called tax deferred. You're not paying taxes on it now, but when you retire and start withdrawing to live on it, you will have to pay taxes on it. But the hope is that you're in a lower tax bracket at that point.
Do you recommend to students when they're young to do a Roth versus the?
My recommendation, which a lot of recommendations
I'm
for
talking about-
financial advisors. Yeah, number one would be if there's a match, number one, you gotta do the match because it's free money, number one. And then if you can do beyond that, the Roth is another opportunity because the Roth is different in the fact that it's still an individual retirement account, but the money that you're putting into it, you've already paid taxes on. Over time, it grows, hopefully. But the benefit is when you're retired and you start withdrawing that money, you don't pay taxes on it. So the growth that you could see, think about it, right? If this is you and you put in 72,000, you pay taxes on the 72,000, right? But when you start withdrawing, you're not going to pay taxes on anything that you withdraw. Right? So that's huge benefit. And the irony with the Roth is you can really only contribute when you make under a certain amount of money. So most of the time, as you're starting out, you don't have that extra money to contribute. And when you start actually earning, it's 170, 80,000. You can't contribute anymore to a Roth when you start earning.
Yeah, the window closes, and these days salaries people are making when they come out of college, it closes a lot faster.
Right.
The other thing to keep in mind, you mentioned the 401k investment match. When you think about it, you're like, oh, can I afford, to put 200 in? Think of it, that's really not 200 coming out of your pocket, because if you had it passed to you, it would have been 200 less taxes. So it's actually costing you less. So keep that in mind.
So questions about this? We will.
Yes.
Yeah.
Yes.
I don't know if it's the right timing or if it's gonna like interrupt the presentation, but I'm 18 and I'm looking at this, I'm like, oh, like it's time, and I know it's been time for like a while now to start investing, but I just don't know like where to begin. I don't know if you guys are gonna talk about this.
Yeah, I mean, if,
But it's a really like big thing, because I don't know where.
sure. Well, first of all, in order to have a 401k, you have to have a job that offers you one.
So you would go more towards the IRA route, whether it be a
Right, so-
Roth or a traditional IRA.
And in order to have those, you have to have earned income. You have to have a job of some sort earning income. And then it would come out of that. So if you don't have a job that offers a 401k right now, which most of the time you wouldn't, because it's part-time work, you're working. If you do have a regular, and by the way, you should, even if you work, say, at a supermarket part-time, some of them do have 401ks for part-time. So you should ask your HR department, is there a 401k even though I'm part-time? Because you can have a percent taken out. And even if you never work at the supermarket after a few years, that 401k is still exists, right? And you can do things with it. It can, right, we can, there's other things to do. So you should find out about that. But those are options if you have a job or if your job has a 401k. If you have none of those options, then you could start a Robinhood account. I did that with my son, he's 11. So we together signed up. It's very simple to sign up. You do connect your checking account to it. And we transfer like $20 at a time, and you can invest in partial shares. So for example, if he wanted to invest in Tesla, it's very expensive stock, and we're only investing $20 maybe every 2 weeks. So, but you can own a tiny piece of a stock of Tesla. See what I'm saying? So Robinhood account and E-Trade account, those are all things that you could do even if you don't have a job or a 401k. And there's plenty others. Those are just two that come to the top of my mind. Anything else? Okay. To invest in, we've talked about some of this.
We already talked about a lot. I mean, a lot of it depends on your risk tolerance. I mean, really safe is your cash. Bonds, they're less riskier. I don't like to use the word safe even with bonds, because I mean, except for the government who has the right to tax and print money and so forth, corporate bonds can still fail. I mean, right now, I mean, look at Bed Bath and Beyond. They're cruising like crazy. I mean, and I'm sure they have bonds outstanding and they're going to
Still a
default
risk.
on them.
Yeah.
So So you don't want to use the word safe with any type of investment, less risky, so corporate bonds are usually less riskier. Mutual funds, it depends on the type of mutual fund is the risk level. You can have an all equity fund, which means it's all stocks. You can have a blended fund, which means it has some equities and some bonds. You can have an all bond fund. So it just depends. You need to look at, your risk level and what best suits you. Very popular these days are target funds. That's a part, mutual fund based on when you plan to retire. The fund manager alters the investments and the risk level. You don't have to do anything, and it's geared towards your retirement year. So early on, it's much riskier. And as it moves towards that target time frame, it changes the investments over time towards your investment year. So those are very popular with people.
And that's why people usually do invest in mutual funds, because we don't always know what to buy and sell at what point in time, but you're basically paying for a professional manager to manage what's in the basket. Whatever investments are in there, that person is going to be watching the market, deciding when to sell something and buy something else. And that's the benefit of
Yeah,
the
and
diversification.
Mutual funds allow you to diversify that a lot of people don't have the ability to do. I mean, many people on our own, we can't mimic the S&P 500. We don't have that ability. So mutual funds allow us that opportunity to diversify in a way that we wouldn't be able to in our own portfolio. If that's great. Know that it's going to come with expenses. Actively managed funds, what Karen was talking about, that has a lot of turnover, they're buying and selling, you're going to pay more. Index funds are going to have lower fees because that's being passively managed because they're really just following that. So you really want to look at what your expense ratios are going to be. Make sure you look at Morningstar ratings on all these funds, it goes up to 5 stars, see what that is, look how the performance has been in the past, look at similar funds, see what those, how it's meeting, against its index and so forth. And that's really what you want to look at when you're taking a look at the mutual funds, but definitely always start with your Morningstar
I
rating.
think the big thing is to start reading and seeing what's going on with companies. It doesn't mean you have to go and use, anything too complicated, but just what's going on even in Yahoo Finance. Read the top 3 bullets, what's going on with companies. And when you start to see companies coming out with something new or some good news coming out, and you start tracking, maybe a company that you use yourself, if you buy Abercrombie stuff, that might be one to think about, or just start to look at. Think of what car you drive or what sneakers you buy, or, things like that are more familiar to you. And that's kind of a good place to start. At least, what is the stock price today? What was it a year ago? What's happening with this company? Do I keep reading bad news about it? Or am I reading about new things, new advancements, new locations, things like that?
And I got plug Bloomberg here. You can get all that in the Bloomberg
Mhm.
terminals, company news, top news, anything you want to know about a company is right there for you.
I designed a course called Bloomberg Boot Camp. It's only 1 credit, but it's for non-finance majors. It's for students just like you who are interested in finding out about how to research these types of things. And you can do most of your research on the internet, but the terminal itself allows you to do it all in one place. You don't have to go to 5, 6 different websites and try to copy and paste. It's right there. And that's what the course does. We, use some of the commands on the terminal to research things like this.
And a fun activity might be if you want to just test the waters, go to marketwatch.com. You can create, a fake portfolio, decide, I think I want to put this much in Apple, this much in Tesla, this much in Ford. And you can just kind of watch it and just kind of get a feel for the ups and downs. And, I did my research company. It was a good, my feeling, my choice, it worked out, my gut, told me it was, the financials told me this was a good investment, it was a sound company, and look, it's turned profitable. But if you're, not sure at first that you want to put actual money in the market, try just doing that account, making the portfolio, and just see and test the waters to you personally and see how you do. I don't know how you feel about that.
No, that's what we do in the Bloomberg Zoot Camp. Bloomberg allows you to create your little portfolio and track it. We track it. We compare each other's easily to see who's doing better. We see in Bloomberg if we've outdone the S&P 500. Some students actually, their portfolio did better than the S&P 500. Some didn't. I look at some of the past years from that class and we pull that in and see how they've done over a past year. You can actually plug in how it would have done through different crises that have happened in the past. It tells you if it had gone through, the Gulf War, what would have happened to this portfolio. So there's a lot of really cool things that you can do with the terminal that we do.
This is kind of related to that in a way, but also to, okay, so you get a job, some of these students will get a job. They'll be able to invest in their 401k. And then they'll get a list of funds that they're able to invest in. And a lot of times, one is recommended, so everybody just dumps all their money in there, but how can they do those stock comparisons? Like, how can they do those comparisons with something from an employer of, mutual or fund choices for their 401k? Like, what's the best way for them to do that? Some of them are gonna be graduating soon and.
Like I had mentioned before, I always say, I recommend right off the top, look at the Morningstar rating. Look at the 4 or 5 stars. I don't deal with anything less than 4 stars, quite honestly. I don't know what you do, but
Well, I mean,
I like the 4 to 5 stars. I see something with 4 to 5 stars. That's the first thing I start looking at. I look at the performance, I look what the holdings are. And I start looking at comparisons. I start doing my research on the fund, look at the manager, things in that
you
area.
can find the information on what that fund has had for a return over the past X years that it's been in existence. So you can see, wow, this fund over the past 10 years earned 12%, then 10%, then lost 1%, then gained 27%, compared to all the other funds. And it then becomes your level of risk that you're willing to take. You'll find out what's in those funds from your job will show you that. Plus, as Christine said, they usually do earmark them also for when you think you'll retire. So when you go in at 22, obviously it's going to be a while. So there'll be a fund that'll be a more risky, fund that's designed for someone who is going to be working probably for 40
And
years.
what's nice about mutual funds, when you go and start looking at the fund, they give you all that. They give you the 1, 3, 5 lifetime return. They tell you how long the manager's been there. They give you all that. You can click top holdings. They give you, that's what's nice about it. It's a lot different. You start doing individual
On your level,
equities
yeah.
and you have to do your own analysis and so forth. Everything is right there for you. And that's why I say I start at the stars, because to me, 4 or 5 stars, they must have got it for a reason. I start there, and they usually tell you a risk level too, it's, high risk, medium, and that's where you start judging and building. But I always look at the stars. I just had to do this for my daughter. She just got her first 401k. She sent me all the paperwork, said pick. And that's what I did. I went through and I went through it. I'm like, here, this. I gave her 4 or 5 funds. And that's what she sent off to HR.
Sometimes if you look at your benefits package too, when you first start, like my
Yes.
last position, I had a 403B and they had a representative from TIAA that was able to come and sit with individuals for free and kind of say, okay, well, you're at this age, this is my recommendation for what you should be doing to diversify. And they would look at your whole package with you, and they can even they try to sell you more products, obviously. But you might have, one of your benefits at your job might be to have somebody come and help you with those
Most likely it
investments.
is, for sure. If they have a 401k option, you just have to ask, say,
Yeah,
who
and
can
the
I
biggest-
talk to that,
And the biggest mistake people tend to make, a lot of people do that, is they get it for the first time. And I think someone mentioned it, they put it in an account and they just leave it in that one account. They completely ignore all the other options. And the whole point is for you to be diversified. You should be in multiple funds. You shouldn't just say, oh, well, this mutual fund's diversified. Whoo, I'm diversified then. Yay, my work's done. It shouldn't be that way. You should be in different funds, because, with different holdings, because that's how you're really diversifying. Because you can have a fund that's in a specific sector. You're not diversified. That sector tanks. You're tanking with it. You know, so you have to make sure, and generally there aren't sector funds and mutual funds, I mean, and 401ks, but I'm just saying that as an example. So you want to make sure that you're picking funds that, you know, you're gonna have some crossover in their holdings, but there should be different holdings, and that's how you're diversifying further by taking advantage of the options that you have. So you want to make sure you pick a nice array that balances, you know, you out well.
Any other questions? All right. So a lot of different things, we're not gonna be talking about them all, but there are a lot of options, which can certainly make things overwhelming. You know, we talked a little bit about what to do as you age with your portfolio. So this was just a nice graphic that you can see, you know, equities or stocks mostly recommended in your 20s and 30s. And then as you start to get older, you'll see, you know, less blue and more purple. And there's formulas Christine mentioned. We're actually do our little risk analysis and give you
And
your
that's what I mentioned, that's just a rule of thumb. It actually depends on how much you have already saved. If you're already someone that has a good nest egg, then a financial planner is going to say, you can have more risk. You know, you don't have to be, you know, by that rule of thumb. It all depends on how much you can assume at that time, because it's based on what your wealth, your net worth already is. And someone has greater net worth, you can be a little bit heavier in stocks later on because you have that worth. So you don't necessarily at age 50 have to be like, oh, I gotta be 50-50. If you have a high net worth, the planner may say, it's okay for you to have a little bit more risk at this point because you can assume it.
so net worth is going to be thinking about all your assets at one point in time. So assets, anything of value, you would think like right now, I have my students actually figure out their net worth, which is negative. It's usually the worst it'll ever be right now. So I have them make a list of assets at this point in time. Today, what's the balance in your savings account? What's the balance in your checking account? What's the balance in your piggy bank? What's the, you know, anything that you have a value, a rough estimate of jewelry, of your clothing that's, you know, if you have fancy sneaker collection or purse collection, you know, phone, computer, car, right? Anything that you might have, and total that up. And then what you're thinking about after that is your debt, right? Debt from borrowing. So that's different than just, oh, I have to pay my phone bill. You didn't borrow money from the phone company, right? You borrowed money for a credit card. So you would subtract the balance of your credit card. You would subtract the balance of your school loans. You would subtract the balance of your car loan. Eventually, your home loan, if you have a home loan. And whatever's left, if there is anything, is your net worth. But over time, right, these hopefully increase because as we make more money, we save more money, right? And if we buy stocks, we have more assets, whatever our stocks are worth or your E-Trade account is worth. And over time, we're trying to pay these down, right? And the goal when we talk wealth is your net worth. So when you hear someone say what their net worth is, that's what it is. So we do that. We talked about common stock, dividends, we mentioned.
We
Little
mentioned
bit.
dividends. The thing with common stock, to keep in mind, when it's in your 401k, your 403b, and IRA, those what we call qualified accounts, and Karen had touched upon it, you're not going to pay taxes now, you're going to pay taxes later. But if you were to, as you mentioned, if you want to invest like in Robinhood, or you go to Fidelity, you open up a standard brokerage account, know that you're going to generate a taxable event here. You know, if you sell stock, you're going to generate a capital gain. That means you sold it for more than what you bought it for. The government wants their piece. You get dividends from a company. Well, that's income. The government's going to want their piece. And depending on what tax bracket you're in, determines what you're going to pay the government. Okay, if you're usually in the first two tax brackets, luckily, they don't want anything from you. Okay, and then they want 15% until you're in the top tax bracket. You're in the top tax bracket, they want 20%. So just keep in mind that if you're outside of one of those retirement accounts, and you're just investing on your own, you can have a taxable event occur when it comes to common stock.
Which is the benefit now of not making a lot of money.
Yes,
Because
because you're gonna be in the lower
When
bracket.
you are in an E-Trade account or a Robinhood account and you're buying stock and then you're turning around and selling it for more money, that gain is supposed to be taxed, but you make so little that you won't get taxed on it, most likely if you're in that threshold. So the irony, right? When you don't have the money, that's when you don't get taxed, so.
Yes.
Can you just repeat what's the relationship between dividends and taxes? Cause I didn't really understand what dividends are. Sorry, I'm really like new to this topic, so.
That's fine. If you,
Do we have
probably,
dividends? All right, just dividends, early companies don't pay dividends because they need all their cash to build. So larger companies tend to pay dividends. And hopefully you've all come to accounting. Companies take their revenue, they pay all their expenses, then they pay the federal, they pay their taxes, and the end result is their net income. Okay, think of that pie as 100%. The company can choose to keep that entire pie for themselves, and it goes back into the company, be reinvested, or they can choose to share it with their shareholders, their stockholders, which Karen mentioned earlier, to keep them happy. So they can choose to pay out a dividend, as they may pay out
which is just sharing the profits with you.
40%, which means they will retain or keep 60%. So this gets broken down now, whatever they pay out by the number of shares, and that determines your
Okay.
dividend.
Hold on.
So that is what a
Completely-
dividend
okay, no,
is. It is a
Let's back up.
portion.
They're just like doing it with
They-
good action.
The company is doing it, the company is doing it for a deduct, no, the company is doing, as she mentioned, to keep the shareholders happy. Shareholders get happy if they get money, because your return, you're investing because you want a return.
Yes.
Your return comes in the form of two ways. It comes from the price appreciation, which means your price went up,
The stock you own
okay?
has more value because the price went up.
Okay, and your return comes from receiving dividends. Both of these are income to the stockholder. Okay. Stockholders are happy when the price goes up, but they're also happy when they get to share in the profits of the company. So when companies are small, they want all their profits. They need that to reinvest, to grow. Because when they grow, the price tends to go up with them, and that makes shareholders happy. And we talked about small cap, mid cap, large cap. Eventually, sometimes companies get so big that they say, wow, with this profit, we can't generate a larger return for our shareholders that would benefit them. So we're going to give a portion back to them, because we're at that point that our growth level has that's what we call like the large cap. They've reached that mature level in their growth, and their opportunities to grow has kind of stalled a little bit. And so they want to make sure that they keep the shareholders happy, and to make them happy is say, all right, our price isn't going to grow as much as it used to in the early stages. So to accommodate that slow in the price movement, we're going to get them income in the form of dividends.
And you can look at a stock in the history of if it ever gave a dividend. So if you bought a stock and it gave $1 dividends 2 years ago and $1.50 last year and maybe $2 this year, when you're buying it, the assumption is it's going to continue to give dividends. So if you own 100 shares and they're giving $1 per share, you're going to get $100 just for being an owner. Sometimes people who buy stock don't want the dividends. They'd rather keep the money company and make the company bigger and better, so the value of my stock gets bigger. So it depends what you want. You could have stocks in a variety of companies that are all giving you dividends, or some that don't, but you want them to keep that money to grow the company. So
Pretty sure like Tesla doesn't pay dividends because they need, they don't,
I don't,
I
I'm
don't
not
think
sure.
they pay. Because they need all that capital.
Remember, I don't
because
have a
they're-
share. I have
They're,
a
they're
one
growing,
hundredth of a
they,
share.
they need all that money because they're still
Your son
investing in
does.
technology and all this other stuff. They need that versus a company like McDonald's. They're gonna pay a dividend. What more can really McDonald's do to bring them to the next level? So they're a company that they're already up here. So they're gonna be a company that's more likely to pay the dividends. With Tesla, I mean, just a few years ago, it's finally they started getting the cars out on the road. Because it took them so many years to get the technology. They kept promising cars, promising. And then finally, getting out there, but they're not at the level that they want to manufacture more per year. They're still in that growth stage. So when companies are in that stage, customers or I say stockholders are benefiting because the price is going up when they're in that growth stage. Whereas McDonald's, their price, it's not doing anything fantastic, and so they reward their stockholders by letting them share in the profits they generate from doing business.
It's more
And
of
that's
like
what dividends
an
are
immediate
doing.
reward, having
Yes.
a dividend, because you know that the company is not like investing in their growth. They're just looking to like be stable and like give this dividends to them so that they can be happy, but
They could not give all of their money, right? So they could still be investing in
Mhm.
growth, but also trying, it's a balancing act.
yeah.
It's so being the manager, the CFO was difficult to figure out what the
I mean,
right decision
I
is.
mean, think about McDonald's. Sometimes they come out with a new prop. Well, that takes some research and development. They need money for that. So yes, they still need, cash to, keep offering maybe some new pros and things like that. But they're not gonna be like at this,
Right.
keep going and jumping up higher and higher and higher. They're at a place that they've matured. You're gonna have some growth, yes, but you're not gonna be riding up, you're not riding up the riches with them. That time has passed. You should have invested in McDonald's back in the 1980s
Right.
and rode it up if you wanted to get rich with them.
What about Amazon? Like where would you, they're public, right?
Yes,
So how would you rate them? Like you're saying Tesla's growing. I feel like Amazon,
You're never gonna stop.
yeah.
Yeah,
Amazon's taken over the world.
it is.
I wish that stock price would do better. Amazon is just a giant. They're kind of hard to really define because they actually fall, I think, about 3 different sectors. Believe it or not, they're like in communications, I think they kind of fall in consumer staples. I mean, they're in like 3 different sectors because they have like the technology plus their online shopping space and things like that. Yeah, I mean, they're gonna keep, I mean, I think they're still gonna grow. Do I think personally, are we gonna see the growth that we saw from them like over the last 10 years? I personally don't think so because they're already a monster, so again, I think they're one of those that we're gonna see some ups and downs and so forth, but I mean, I could be wrong, unless unless a game changer comes out with them. I don't know, I feel that ride up might have already gone, but I mean, again, there could be some kind of game changer, or they could choose to maybe, buy out something that gives them a different space, in another, that's a game changer. But I'm saying as they are right now, I kind of feel like they're gonna be like a,
Plateaued.
yeah, I mean, I don't know if you feel differently,
No.
but I think there's gonna need to be a game changer, but I wouldn't put it past them because Amazon is one of those companies that keeps
Innovate.
redefining
Yeah.
themselves, and so I wouldn't be shocked if they do something else that you're like, oh, all right, they're genius. So I wouldn't be shocked by it,
So we have 5 minutes left, so I want to
Oh,
wanna
it
make
goes
sure
for
that-
5?
I think so.
Yeah.
Oh, I thought it went to 5:30. I thought we still
No,
talked.
it's
I would
like
not talk so much.
Started working.
What would be best to end this? Do you have more questions? We also could go and look at an individual risk assessment if you wanted to see what it might look like and what might be recommended. We could look at how to read a stock quote. We have both of those prepared. So what would you, or just ask questions if you have any.
Hi, Jane.
Yeah, actually just curious, is this something that would be possible to be like a recurring thing?
That's your finance
Alright,
class. Sign up for finance class. That's what we do.
It's like students who
Yeah.
aren't able to fit in a finance class and like.
That's the,
their schedule.
what I did the
Thank you,
Bloomberg
guys.
boot camp. So one credit class, that's this is what we do.
Yeah.
But as far as, what was that?
I still can't fit it.
A one credit? Oh, what, are you a senior?
No, I'm sophomore. The second semester sophomore, but I have already like all my credits lined up. And so,
They were asking, well, how could we do this more often? I said, well, we could take classes because that's what we're teaching.
Oh, no, I mean, we could maybe think about starting a women in finance club.
Yeah, I mean, we definitely can.
Like a
That's a great
podcast or
idea.
something too. you know,
Yeah.
There was
that's
like
not
the
super-
club and I'm part of it, but it's like nothing happens. Like the only event like ever happened was like watching.
This was
No,
very
and no one
informative
wants.
and like, I feel
this
like
is
we
actually,
just
like,
touched and it was like a really comfortable setting to ask questions or say what, you know what I mean? Where
you. We-
sometimes.
Yeah. I get
So
that.
we still have a
Going
lot of-
amongst your male counterparts. you
Of
might not
course.
be
We still have a
able to
lot of slides left. guys.
Yeah, no, I
Or-
totally understand that, you know, it's not, we didn't know what the level was, we
Yeah.
figured we were just going with introductory and see how it was.